Hello, dividend growth stock investors. Happy Sunday to you. It is Colby, the DGI Crab. It is November 2nd, one day before this crab's 42nd birthday, where I'm going to be graduating into a new group of stocks to invest in. I'm going to talk about that and a whole lot more here on today's video, where we look at the undervalued stocks going into the trading week and see where the value lies. This is a unique dividend growth investing channel in that this is only going to be a channel that focuses on 60 dividend growth stocks, but I've taken that group of 60, subcategorized them, and put them into separate tiers based on the age and time horizon of the investor. That is right, you guys. We're going to be looking at yield, PE ratio, different things like that when you're a dividend growth stock investor. But the main thing you ought to be thinking about is your age and your time horizon. The more time you have in the market, the more you want to focus on growth. The less time you have in the market, current day yield comes into play. So whether you are 18 years old or 68 years old or somewhere in between or even older than 68, hey, you got to buy quality, you guys. You got to buy quality no matter what your age is. And that is the name of the game, what this channel likes to discuss. So, let's get right into it, you guys. I'm not a professional financial advisor. Do your own due diligence before you invest your hard-earned money. My personal strategy, you guys, if you're new, take a look at this. If you are not new, you could skip ahead, but I always put 50% of my new money every week into age-appropriate ETFs, so my portfolio automatically has diversification. And then when I'm buying my single stocks, I'm looking for the ones that are yielding 30% or more above their 4-year average yield. I want to purchase my passive income at a discount. I have a list of my personal top 10 favorite stocks that I think are bulletproof, that I want to have large positions in. By the time I reach financial freedom, I'll buy those if I'm in the mood. To be quite honest with you, I don't always wait for them to hit that 30% undervalued mark. I do remain within my own age tier unless I'm purchasing a stock at a different age tier that's yielding 50% or more above the 4-year average yield. At that point, I feel like there's enough of a chance for not only really high starting yield, but also some opportunity for share price appreciation. And then if there's not a viable stock in my tier, I just will add more to ETFs that week. If I don't want to add more to my individual stocks, if there's just not anything that gets me excited, I'm not going to take the week of investing off. I'm going to take that money and just put more into the ETFs and keep that passive income needle pointing up. So we're going to jump into the list here, you guys. First of all, I like to start now on my top 10. These are my top 10 favorite dividend growth stocks, regardless of age tier or anything else. And I have all of my stocks sorted by the valuation metric, where I've taken this number by comparing the 4-year average yield to the current day yield to see how far off it is. So, for example, 4-year average yield on Pepsi is a starting yield of 2.97%. I update this every weekend, so this is as up to date as we can get for right now. And the current day yield of 3.89% is 31% higher than that 4-year average. So that just means if I want to add $5.69 worth of annual dividend income per share I buy of Pepsi, I'm getting that $5.69 at a better price right now than I typically would be getting it at over any point in the last 4 years. It's really as simple as that. So Pepsi to me is in the green. It is in that 30% or more undervalued, but there are 6 of my top 10 that are at least 10% or more undervalued, and that has me quite excited, I must say, going into the week. I may be buying quality over quantity. Now, I think all 60 of the stocks this channel covers are quality, but I will take preference over some, or take certain preferences over some than others. That top 10 group to me is my personal rule breaker list. Now, if I go into my tiers here, this is the Tier 1 category, the 18 to 30-year-old investors, where our starting yield with this group of stocks is generally not going to be super high. We're talking 1 to 2% starting yield, but well above 10% dividend growth year over year over year. We want these compounders that are going to be in our portfolio for decades, that are going to, after that much time, really be generating a massive amount of dividend income, and it's going to grow year over year over year. United Health and Nike, these two stocks have just been beaten down for quite a long time right now. Their dividend growth rate is going to be a bit slower than we've gotten used to over the past 10 years or so, but we're going to get a starting yield in the mid 2%, which is certainly a lot higher than the average starting yield you're going to get in this particular group of stocks. Nordson, you can keep buying Nordson if you like. It's pretty darn close to that 30% mark, no doubt about it. And automatic data processing, if it's not in my top 10, you guys, but is it in my 11 through 20? No doubt about it. Automatic data processing is an absolute monster of a dividend growth stock. You can get that starting yield at 2.37% at current prices right now. They're going through a little bit of a slump that is about 20% higher than the 1.96% for-year average. Automatic data processing, major quality on that one. And then you guys, Visa has done a dividend increase here pretty recently, and that has caused the current day yield to go up a bit. And Visa has not been at all underpriced recently, but the temporary boost, the yield has jumped up a bit in the short term because of the dividend raise. So if you want to swoop in and add a little to your Visa right now, we haven't been adding any Visa for a while, so this could be an opportune time to do it. Waste management below $200, it is yielding 10% higher than the 4-year average. Definitely one of my favorite stocks, and even as a tier 2 about to be a tier 3 investor going into this week, I'm tempted to continue to add to waste management. That starting yield of 1.65% may not be exciting to young investors, but this is such a great stock, you guys. You just got to accumulate it when you're young and hold and reinvest those dividends. Tier 2, age 31 to 41-year-old investors, starting yield's going to be more in the mid 2 to mid 3%. High single-digit dividend growth is what we want out of this group. Plenty of choices in the Tier 2 category. Once again, Target has been the number one undervalued stock in this category for a little while now. Starting current yield has been above 5% here and there for the last few weeks. And so long as Target remains under $100, it's going to be hard for me not to want to continue adding to it. Obviously, you guys, if you've been here for a while, you know that I have been a major proponent of Hershey. I know their dividend growth hasn't been announced for this year, and that is kind of a bummer, but they had a massive dividend increase last year of just shy of 23%. So I could just about forgive them if their dividend growth is flat this year, even though I do find that very annoying from a streak perspective. But if you like streaks, American States Water, McCormick, both long-standing streaks of increasing dividends, greats to add here in the high starting 2%, and Starbucks right there in the buy zone for me. Also, keep an eye out on McDonald's, starting to get a little bit juicy here, no pun intended, about 12.8% undervalued. Hard to go wrong with McDonald's. Union Pacific, the railroad still looks to be trading at a little bit of a discount. Once again, from the two of these from my top 10, lots of choices here. Air products and chemicals I'm keeping a close eye on now as well. It's at that 20% undervalued mark. Loads of choices here, you guys. Can't go wrong with any of this stuff. Hard to even know how to prioritize this, depending on how your portfolios are weighted. You just have to pick the ones that make the most sense for you at the time. Tier 3, age 42 to 53-year-old investors, not as many choices in this category. We want to get stuff that's in the definitely 3% starting yield, hopefully, and maybe even into the 5%. We want to get mid-single digit year-over-year dividend growth out of this group of stocks. These are going to be your steady Eddie stocks. Not a lot of major surprises in here. Boring stuff, right? Coca-Cola, Procter & Gamble, Genuine Parts Company. Stuff that doesn't make the headlines a lot, but performs admirably and stably. Hormel, you guys, this one may be the story of the week. Just continues to crater. I really thought about $23 was the floor on this one, and it just keeps finding a new floor. The current day yield has gotten up above 5%. Yeah, I do feel a little bit nervous about this one, you guys. I'm still adding to it, and this week I'm graduating into this tier 3 category. I'm turning 42 tomorrow, you guys. So this group of stocks is going to be one of my top priorities, and it's going to be impossible for me not to add even more to Hormel going off of my own metrics. I've been trickling a little bit of money into it as a tier 2 investor for a while now, because it's been yielding 50% or more above the 4-year average yield. This number continues to climb. The yield itself continues to climb as well. I'm just going to buy the well above 5% starting yield, I guess, at this point, and hope for the best. I'm not quite at financial freedom with the dividends in my brokerage account just yet, you guys, and I don't want to reach for high starting yield. I want to continue to buy stuff that's going to grow. Hormel has been increasing their dividend. They've slowed it down, but they're not breaking their streak. They're a dividend king. I think their dividend yield is safe. So you buy it now, get paid to wait, hope for the recovery story. At this point, if it gets back up to the $30 a share range where it had been for quite a long time, you've got an amazing recovery story. They're like almost a 50% return on the share price. Tier 4, age 54 and older, you guys, this is the starting income group here where we want to get 5% or better. And we still want to get some dividend growth if we're buying the single stocks. It's just maybe we're getting 2 to 4% or so. Definitely some REITs in the category are starting to look appealing. Essex Properties now has gotten into that number 1 spot on the list. NNN REIT, if this one hits 6%, this one's pretty appealing, kind of like when Realty Income was getting way up there north of 6%. Same for NNN REIT, not a bad place to start. And then One Oak, I was talking about this last week, you guys. I'm kind of convinced here that the starting yield above 6% may actually be a sneakier, better yield to get here on this one than we might think. Because there was the acquisition of MMP within the last couple of years. So there's going to be some reasons to go outside of the metrics on One Oak. So if you want to add this one here right now, yielding well above 6%, I can't say that I blame you here. So now let's talk about the priorities for the tiers, you guys. If you're in that tier 1 category, age 18 to 30, first thing, start off with your ETFs. I like to prioritize things like the S&P 500, a small cap value. I love starting a small position in VIG and growing it when you're younger than 30, just to kind of get the dividend snowball effect rolling for you. And then you're also going to have your VYMI, which I like to do about 5% across the board in VYMI, just to have some exposure to international stocks. Then I'm going to look at top 10 positions. So Pepsi certainly would be a priority. And then Waste Management and Visa look great for this group for the young investors. The N-tier values, so United Health and Nike, definitely major values within your own tier. And then if you're looking to buy the dip on anything yielding 50% or more above the 4-year average, you could look to Target or Hormel perhaps, but I wouldn't prioritize those over the previous ones here on the list. And then you just keep an eye on Nordson. If it goes up, I wouldn't be adding any more to it right this second. If it dips another dollar or so a share, maybe you can keep adding back into that one. And then automatic data processing for sure. Keep an eye on it. If it keeps falling, it could be one to add to your buy list. Tier 2, same for ETFs, just a different weighting. And then I'm going to be looking at Pepsi, McDonald's, and Union Pacific first. In tier value, Target, AWR, Hershey, McCormick, Starbucks. Buy the dip options, UNH, Nike, Hormel. Watch list only, Texan, and APD. Tier 3, SCHD, VYM, DHS, VYM. Top 10s, Pepsi and Procter & Gamble. In tier value, Hormel. Buy the dip, UNH, Nike, Target. Watch list, AMT. Not quite in the buy zone, but very close. And then tier 4, all of the great income ETFs, Pepsi, One Oak, maybe the two to prioritize if you're buying single stocks. But I'd probably be mostly looking at these ETFs, guys, if you're in that tier 4 category. Just diversify and wait.